welcome back to Logic and Finance. I'm Adam Ormsby. We've heard a lot about Jerome Powell and his money printer over the last 4 years. So I wanted to break down a view of who inflation actually affects and how it affects them. Is it always bad? Can inflation be a good thing? So we're going to look at inflation from 4 different perspectives. That of a new college graduate, that of a new homeowner, using myself as the example, a billionaire like Elon Musk or Jeff Bezos, and your average everyday grandmother. And not to spoil the end, but there is going to be a secret 5th player as well. Just to set the foundation, I want to say now that printing money or inflation is a zero-sum game, meaning net, it does not create or destroy value. It just moves value from where it currently is to somewhere else. So the value gained in new printed money will be equal to the value lost in money that was already in circulation. The only caveat to that is the potential loss of goodwill in your currency. People thought the US dollar was going to lose a substantial percent of its value every year. People would no longer want to transact in that currency anymore. That's why the US dollar has been so prevalent as the world currency over the last several decades. It's a sense of trust in the US the world over that tomorrow a US dollar will be worth almost as much as a dollar is today. And it makes people willing to transact in US dollars. As long as we maintain that sense of goodwill, our foundational rule holds true, and inflation will be a zero-sum game, where we're just moving value from one place to another. If we look at the Venezuelan bolivar, we see the effects of hyperinflation, where the whole country is turning to Bitcoin as an alternative because they no longer trust their currency after the massive inflation rates they've had. So for today, we're going to assume that the US dollar is not heading towards bolivar territory and hyperinflation, but that the inflation that we've seen in the US over the last 4 years is really just moving value from place to place, and we're not losing too much goodwill. Without further ado, let's start with our college graduate. College graduation is a time of great pride, a time for self-reflection, a time to realize you are broke and need to start a career and earn money to survive. So how does inflation impact you? When you look at the balance sheet of a new college graduate, it's basically zeros all the way across. You might have a few $1,000s saved up from a college job, or you might have a few $1,000s in student loan debt, but net, you're pretty much at zero. When you're starting with nothing and suddenly inflation hits, so a gallon of milk or a gallon of gas costs more dollars, it feels intuitively like that's a bad thing. But similar to milk and gas, you can now charge more for your labor. There's an argument that the price of wages are stickier than the price of goods, because it's easier to change the price of a Big Mac than it is to get a promotion or raise at work. But if the US Department of Treasury is to be believed, that's just not true. Between 2019 and 2023, wages grew in excess of the unprecedented inflation we faced. You might even be one of the rare few college graduates who took on student loan debt. If you have, congratulations on the inflation. If you owed $10,000 before the 20% inflation of the last few years, that's now closer to $800 of the previous value. So your potential wages grow with inflation at the same pace as the cost of goods and services. And if you had a student loan, you now owe less value due to the inflation. Inflation for a new college graduate ultimately is neutral or good, depending on the size of the loan you've taken out. Now we can finally move our tassel to the side and take a look at our new homeowner. I said moving on to the new homeowner. I am so sorry about him. We're still working out the bugs here. Now, moving on to the new homeowner, using myself as the example, how has inflation impacted me? Well, as we said for the new college student, having debt when there is inflation is a good thing. And homeowners, particularly new homeowners, have plenty of debt. What we also have is a house. And you know what goes up in value with inflation? The value of a house. So using myself as the example, I paid $220,000 for this house in early 2020, but I only had a down payment of about $40,000. The other $180,000 needed to be borrowed from a bank as a loan or debt. Just the impact of inflation on my house of 20% would raise the nominal value from $220,000 closer to $264,000. But the value of what I owe the bank stays steady at $180,000. Because the value of assets grow with inflation, but the value of what you owe in debt to the bank stays the same. So when you borrow money to buy an asset like a house or a car, inflation has been extremely good for you. So if you're a new homeowner, inflation has been the bee's knees. I can already hear the younger millennials in the comments section going, "But Adam, the rise in housing prices is unsustainable, and it's terrible the fact that houses have gone up so much in price." And yes, you're not wrong. The idea that housing has gone up so much over the last 50 years that houses are barely affordable for anyone is a serious problem. I'm just saying it's not because of the price level increases due to printing money. For additional information, here's Grok with a breakdown. Over the last 50 years, home prices have significantly outpaced inflation. The United States home prices have increased 1,608% since 1970, while inflation is just 644. This means that home prices have grown more than twice as fast as general inflation. And there are other factors leading to the unsustainable rise in both home prices and college tuition, but just printing money and the raises in price level doesn't actually change anything. Next, let's take a look at the world's wealthiest man, Elon Musk. So if he's worth $100 billion and there's 20% inflation, surely it must be bad for him. He must lose $20 billion, right? Right? Wrong. Because contrary to popular belief, Elon doesn't just fill an Olympic-sized swimming pool with the gold bars and dollar bills and Scrooge McDucket. His wealth, like most billionaires, comes from the ownership of stock. In Elon's case, it's Tesla Motors and Tesla stock. So the value of Tesla is made up of property, plant, equipment, the future cash flows from the sale of cars or self-driving technology. But the value of property, plant, equipment, and cars, similar to my house, goes up with inflation. So the real value of Elon's wealth remains unchanged. Tesla ultimately is a $500 billion company, but net only about $16 billion of that is held in US dollars. So when there's a 20% inflation, that $16 billion in cash is what's devalued, not the full $500 billion company. So Tesla loses about $3.2 billion in real value when we have that 20% inflation. Of course, while the real value of Tesla, adjusting for inflation, is down about $3 billion, the nominal value still rises. And Elon Musk's compensation is tied to the nominal value of Tesla's stock, not the real value. And he gets a lot of stock options just because of an increase in price of that nominal value. I was actually a shareholder of Tesla back in 2016 when we, the investors, voted on a crazy compensation package for Elon, where he wouldn't make any money unless the stock price doubled over the course of the next 7 years. So of course we all voted in favor of it because the stock price doubled. We, the investors, would be very happy, and Elon deserves a reasonable portion of that success. Tesla ultimately did the impossible. It's up nearly 800% over the last 8 years, making it one of the 50 largest companies in America, creating hundreds of billions of dollars in shareholder value. Elon getting a small portion of that value added as his compensation for creating and running the company is completely fathomable. And as someone who invests in a lot of high volatility things, I can honestly say Tesla is the second best performing investment I have made over the last 7 years. So it's not only fair to shareholders, every Tesla shareholder's only regret is that they didn't buy more. Wait, this just in, apparently a judge named Kathleen McCormick out of Delaware somehow vetoed Elon's pay package because it is, quote, an unfathomable sum, and that it was unfair to shareholders like me. I guess that's a thing judges can just do now. Maybe she's super corrupt. I'm extremely confused that this could happen. Blatantly untrue, everything that is in her litigation. Probably deserves a video all its own at some point. But today we're just focused on the impact of inflation. So without Elon's completely justified, voted for by shareholders such as myself, compensation package, I guess inflation has cost Elon a couple $100 million, also to him known as a rounding error. Sorry, buddy. But let's take a look at our other friendly billionaire, Jeff Bezos, whose get big fast motto involves taking out lots of leverage and taking out loans to grow Amazon faster. So Amazon's cash balance, like a lot of large corporations, isn't actually positive. It's negative. It's actually negative $80 billion. So similar to me owning a home, the value of the assets, what you own, continues to rise with inflation, but the value of the debt you've taken on, what you owe, does not. So having 20% inflation actually made Jeff Bezos' Amazon about $16 billion worth of value just from the inflation. Moving right along, we're going to take a look into our secret fifth player, who is, you might have guessed, the US government. Considering the US government gets to spend every dollar that's been printed by the Burr machine, they've gained a lot of value over the last few years just from the printing money and inflation. We can argue until the cows come home if they spent it well or if they could have spent it better, but the fact remains, when thinking about inflation, we need to recognize, for better or for worse, the government gains a lot of value from it. Not only do they get to spend every dollar that's been printed, but the US government is famously in debt. And we've seen a consistent message that if you're in debt, inflation is good for you. They're actually so famously in debt, it's to the tune of $35 trillion. So when there is 20% inflation over a few years, the real value of what the government owes drops by $7 trillion with a T dollars. There's a wonderful website called the US Debt Clock, which I will link in the comments below. For additional information, you should definitely check them out. It might be a mild conflict of interest that the government is in charge of printing money, but what do I know? I guess that wraps things up. Inflation wasn't bad for our new college graduate or Elon Musk. It's been pretty good for Jeff Bezos and I, and the US government has made trillions of dollars in value over the last few years just from printing money. Maybe I was wrong at the top of this video. Inflation is actually a good thing. It just creates value. There is no problem with Jesus Christ, we forgot about Grandma. Okay, well, it can't be that bad for Grandma, right? Let's take a look at her assets real quick. So we said that inflation is bad for people who hold US dollars, and Grandma is on a fixed income, so she can't afford the risk of the market like Jeff Bezos or I. So she does have a lot of cash on hand, and for the investments she does have, her financial advisor recommended fixed income or bonds, which is like when Amazon needs to build another factory and they take out a huge loan. Grandma is the one who lends Jeff Bezos the money. And in the same way that it's good for Jeff Bezos because the real value of what he owes goes down, the other side of that is what Grandma owns, and the real value of what she owns goes down. And I guess all the value I gained because the real value of the loan on my home didn't increase is a loss for the bank who issued me the loan, or even worse, they packaged it into a collateralized mortgage obligation and sold it as a fixed income security to someone like Grandma. And the value that the US government gains, while most of their $35 trillion in debt is held within the US, about $8 trillion of that is held by other countries. So when we have 20% inflation, they lost $1.6 trillion to the US's gain. So inflation isn't just bad for people who hold US dollars in their wallet, it's also bad for lenders, like the bank who gave me money to buy my house. It's so odd that there was unprecedented inflation followed by an unprecedented rise in interest rates, and then a couple fairly stable banks failed. That can't be related, right? I guess the moral of the story is the math was right. There's no value created or destroyed by printing money. It's just if you held US dollars or have loaned US dollars to someone before unexpected inflation, the inflation is going to be bad for you. If you have negative US dollars through debt that you've borrowed through someone, inflation is going to be good for you. And actually, the exact amount of value gained by the US government for printing new dollars is the exact value lost by everyone who currently holds dollars. The exact value gained by people who have borrowed money is the exact value lost by people who have lent them money due to the inflation and the changes in the price level. So at the end of the day, when we're looking at the last 4 years of Jerome Powell's money printer, we can say, if you're a new college graduate or Elon Musk, you're probably not actually that affected. If you're me or Jeff Bezos, it's probably been pretty good for you. It's been wonderful for the US government. But if you are on a fixed income like Grandma, or otherwise hold US dollars or have loaned US dollars, inflation has been pretty catastrophic for you. But that's just what I think. What do you think? I look forward to hearing from everyone in the comments down below and seeing you on the next video from Logic and Finance.